These are 4 tax loopholes the rich do not want you to know, and this is exactly why I don't pay any tax legally, and other people, of course, can do the same. Welcome, Eric.
Thanks for having me again.
So let's start with number 1, retirement accounts. These are some of the main strategies.
Right. This is big because this could apply to pretty much anyone. So this isn't just a trick for the wealthy, although they use it quite frequently, but most people can use this. So I'm actually shocked most of the time how few people actually take advantage of this. So most employers are going to offer some type of 401k or retirement plan. And it's not just that they offer the plan. A lot of times they're going to offer some type of match with it. And so that's essentially a way to increase your salary, right? If they're matching whatever it is, they typically will match 50% to 100% of whatever you put into the plan. And so this is an easy way to take advantage of those tax savings. And there's different types of retirement plans too. So you can layer them on. So even if your employer doesn't offer a 401k, you can actually use things like Roth IRAs or traditional IRAs to contribute. And those are great because you don't have to make those contributions until after the year is over. People in certain situations, like younger, meaning longer time until you retire, and they typically have lower income, Roth IRAs can be a huge tax benefit. And the wealthy have used this too, but a Roth IRA, what makes it different is it's almost like the reverse of a traditional type retirement account where you don't get a deduction when you put money in, but when you take the money out in retirement, it's all tax free. So the reason why this is great when you're younger or when you have lower income, say you're between jobs or maybe you have a big write-off for whatever reason, using a Roth IRA is great because you owe tax on it, but you want to do it when you're in a low tax bracket. Then when you're in your retirement and maybe you have other passive income or something that you've built up, well, all the Roth distributions will be tax-free.
Right. And I've even heard people moving a retirement account into a Roth.
Right.
Right.
Exactly.
So it doesn't mean it always has to start with new money, right?
Yeah. So it would be like a Roth conversion.
Yeah.
Where, if you have like a traditional IRA, then you could convert that. And so you would pick a year typically when your tax rate is lower for whatever reason. So you don't want to convert typically when you're at the highest marginal rate. But instead, I would say, if you're in the 20% or lower, marginal tax brackets, that's probably a time to start thinking about whether you would make that conversion as a general rule.
Yeah, because here's the deal, guys. If you have an IRA and a Roth IRA and you plan on keeping them both, there's no reason not to do a Roth, because at the end, which is hopefully both of them, the Roth is tax-free.
Yeah, it makes a bigger difference than what you think. So I've run the numbers a couple times, and I mean, your tax rate, if you think about it, if your tax rate is, let's say, 25% in retirement, and so, just to use an easy number, if you have $1 million in a Roth and it's tax-free, you get $1 million, right, in retirement, versus that same $1 million in a traditional IRA is only $750,000 because of your tax that you're paying when you withdraw it in retirement. So, I mean, that's a pretty substantial difference.
Okay, awesome. Thank you. And what's a cash balance plan?
There's a suite of different retirement plans. It's kind of like walking in a candy store, maybe even more exciting because, you're saving on taxes. But a cash balance plan is basically it's just a different form of a retirement plan that is typically, can be used by, I would say it's more for like service professionals and things like that. So like CPA firms, lawyers, things like that will tend to use these. And you can set just, you basically determine what your benefit's going to be in retirement. And based on that, you make certain contributions to it to make sure that you're going to get that benefit in retirement. So it's different than...
Is it like a defined benefit?
Similar, kind of similar. It's kind of like a variation of that. Which is the opposite of like we were just talking about Roth IRAs and traditional IRAs, things like that, where you're putting in a certain amount of money but you don't know what you're going to get back in retirement. This is kind of the opposite. I'm planning to get this based on my age, how many years I'm working, things like that. And so this is how much I have to put away in order to get that.
So you start at the end and work backwards.
Exactly.
I see. And how do you set one up?
Hire a professional. I wouldn't even want to do the calculations on this one. So a lot of times, you want to make sure, I would say this is for businesses or individuals that are probably at least making probably 400,000 and up, just to justify the additional cost, because there's other plans that you can do before you get to that level. This is just once your income reaches a certain point and you've exhausted some of the other plans, this is kind of the next layer.
But let's talk about profit sharing before we jump off of retirement plans.
Yeah. So profit sharing, this is a big one too, whether you're an employee or an employer. So this can be a part of different types of retirement plans, but a lot of times if you're working for someone, they'll have a 401k and they may have a profit sharing option, which is basically where the company agrees to contribute a certain percentage on your behalf. And this is separate from a match. This is literally they're doing a calculation. They're saying what are the profits to the business, and they're spreading it out based on what your salary is. So this is something that a lot of times you don't have to make contributions to take advantage of this. This is something you'll get anyway if your company has this, but it's also great for self-employed because this means you can contribute your annual limits, then you can do a match of those, and then you can do a profit sharing on
Really good
it.
for self-employed.
Right.
Wow.
Exactly.
Okay, so it's actually significant for them.
Yes. Yeah.
Because if you're self-employed, you can contribute up to the limits.
Yeah, even more than the standard limit. So like for I forget what the exact dollar amount is, but say I think it was like 20,500. Don't quote me on it for in 2023. So that would be what most employees could contribute. Then maybe there's a match on top of that for whatever it is.
That's a good deal.
5,000, and then you can do a profit share on top of that, which depending on how it's set up and whether you're an owner or not. I mean, it could easily be 30,000, 40,000 on top of that. So you're now tripling the amount that you can put in by layering these three things on.
Wow. That's awesome. So let's jump to number 2. And this is one of the most confusing things. And, having how a business can subsidize a lot of costs. This seems to be like a moving target.
So this one's really interesting because I like to think of this as having a business is basically subsidizes your personal costs, also. So typically personal expenses aren't deductible or they're very limited. But by having a business, you convert essentially what would be non-deductible personal expenses into deductible business expenses.
So before we jump in, an action step would be for somebody to set up an LLC and create a business.
In
the current tax year.
In the current tax year. Now, the important thing is make sure it's actually a business. So don't just set up an LLC and think, oh, just because I have an LLC, right?
Okay, so that won't work. So what are the tests?
So I would, as a baseline, when you're thinking about this, think about what knowledge you have or what you're good at or what you're doing anyway, and if and how you can monetize it. So like for me, it was I grew up working with my dad on the rental properties. And so when I started working full time, the natural thing was, I'll start investing in rental properties. And so making a business out of that. And all of a sudden that starts to unlock the rest. So you want something that has income.
Got it. But you could be renovating a car. You could be cleaning houses or Airbnbs on a weekend or whatever, right?
Yep. Uber driver, whatever.
Turn that into a business account.
Yep. Yeah. And almost anything you can figure out how to monetize. But yeah, you want to it's okay to have losses. You just don't want to have losses year over year. So the IRS is going to assume at a certain point, if you have I think if you have a loss 3 out of 5 years, then you're presumed to be a hobby and you can't take the deductions.
Got it.
So you want to try and generate something that actually.
Well, let's talk about the Uber driver, okay? Because the first one here is they have a home office. So how would that work?
So I would say the Uber driver's probably not a great example.
My office is the garage, but
it is an interesting.
Come on, I'm always bending the rules.
That's true. You know,
My office is a garage. I'm an Uber driver.
yeah, I mean,
Why wouldn't I be able to?
you have to store the car. I think where it's going to make a difference is how much of your income is from being an Uber driver. So for example, if you have a 9 to 5 job and you're just Ubering because you're bored on a Saturday night,
If you're not, like,
Right.
well, there's some people,
Yeah.
people are using Uber right now to make ends meet.
yeah, no, if it's like your full-time gig or you're making most, if not all of your income from that, that's a very different situation, right? So, which is kind of important to think about in all the types of businesses is what's deductible in one may not be deductible in the other and vice versa. So in an instance like that, yeah, your automobile probably is, 100%, maybe more, maybe slightly less business use. And so now your garage is more storing a business asset, right?
I
Versus
like the way this is headed.
right? Versus the opposite, if it was a small amount of your income now and you only drive it 10% of the time, well, garage isn't quite the same. So you kind of have to think of
Yeah, you
it
got
that
to
way.
think that through. But the point is that it could be a good strategy.
Yeah, and there's a lot of others. So I mean, you mentioned the home office. That's a really important one because a lot of things that you're going to do, you're performing tasks at your home, right? Like, whether it's administrative type tasks, maybe some are even like meeting clients there. If anything that involves like paperwork, I mean, you got to do your financials, all these different things. You're doing Zoom meetings out of your house. And so you're paying for your house anyway, right? You're either going to have rent or your mortgage regardless because you need a place to live.
Right.
So by doing this, now all of a sudden you make it deductible as a business expense instead. And you can even, if you have something that needs inventory, that's kind of an interesting area because you need to have exclusive business use in a particular room. So in other words, you can't use like your kitchen and call that your home office because you're cooking personal meals there. But you could use, a bedroom as your office, and that just has to be used for business. You can't have, the kids' toys in there playing around because it's not exclusive. But with inventory, it doesn't have to be exclusive use. So you could have inventory of some kind stored in different, in one room that may be used also for something else, and that entire area can be written off, even though you may be using some personal use there.
Right. And then I see there's travel could be deducted too. So let's say you're doing, several renovated cars that you're running up through Barrett-Jackson in Scottsdale here every year. You could actually take a trip to Scottsdale, bring those cars out, and turn that into a vacation, right? And obviously sell those at Barrett-Jackson and write that whole trip off.
Yeah, as long as your principal purpose for the trip is the business, and then you add on the vacation, right?
Yeah.
So and a lot of times these events, like what you're talking about, like those are things you want to go to anyway. You're actually having fun doing it, or maybe you're visiting someone, or there's something you can do once the business is over that is more of a vacation. So like for me, one of the things that I like to do is I'm a big poker player. So I would schedule continuing education classes in Las Vegas. And so I'd go do the continuing education class. And then at night, I'd go walk across the street to the casino and I'd start playing poker for the next 8 hours. And so that was my vacation.
Wow. But when you're playing poker, you can't say it depends.
Actually, you can.
Okay. Good one. That's a really good idea. Okay, number 3, pay the fair share of self-employment tax. In other words, not too much. So what do you mean by that?
What I mean by this is, as an employee, you're paying self-employment tax because you're paying half and the employer is paying half of it. But when you're self-employed, you're responsible for all of it. So this becomes a pretty large tax expense for your business. So you want to make sure that you have the business structured correctly so you're not overpaying. So because a lot of times you may be paying too much if you're not structured correctly. So things that you can do for this, if you are in a service type business, is you can either use S corporations or you can even use partnerships to avoid a portion of the self-employment tax. You just have to be careful that basically to avoid it, your income has to be generated off of things other than what you're doing yourself. So in other words, if you have employees helping you in your service business, part of the income you're generating is basically that you invested in those employees. It's not just that you're, doing all the projects yourself, calling all the clients yourself. They're doing a lot of that. So you shouldn't be paying self-employment tax on that. Instead, they should be on their wages. So, but if you have a Schedule C, you're paying self-employment tax on all of your income. So just by converting to an S corporation, you may make a savings if that's the case.
So that's what I was going to ask. You said use efficient tax structures, so like an S corp, or structure the partnership correctly. So can you walk? Let's say somebody's looking at that now. What should they look at, and what could they do?
Yeah. So I would first look at, number one is what's generating the income. Like, is it something other than just me? So that's the first thing. If the answer is, yeah, it's something other than just me, then keep going. Then look at how much income am I generating? And I would say probably start looking at, once you hit 100 grand or more, you want to start considering whether you're being efficient or not. Because below that, to do these structures, you're either paying more than what you're saving, or you really aren't saving anything because it's just not enough. It's just not enough income to make sense. So those are the two things that I would look at.
Okay, that's fair. All right, so number 4, which I love, it's my favorite one, is depreciation. If you guys don't know what this is, you've got the man right here to tell you what it is. But this is primarily the biggest reason why Ross and I don't pay tax legally, right?
Yep. This is the number one reason for sure.
Yeah.
So depreciation is essentially when you have a large purchase, the IRS says, well, you will get the use of that asset over multiple years, and therefore you can't take that deduction in the current year. Instead, you have to spread it out over some predetermined time period. So the reason why this is so big for Ken, because of all the real estate, obviously you're going to be receiving the benefit of that for more than just a year. So the IRS says you have to take those deductions over time. Now, what makes depreciation special from most other deductions is that it doesn't correspond at all to the real economic value of the real estate, right? Like the real estate could go up, it could go down, it could stay the same, right?
Yeah.
Either way, you
doesn't even matter how it's operating.
Exactly.
Yep.
Yeah. So that's what makes it so great, and that's why I call it a fake deduction, because it's not real most of the time. Like look at any real estate from 30 years ago, and it'd be hard to find one that's worth less, right? Like it's a challenge.
I love it. Well, so essentially the IRS allows people to depreciate their home because from their view, it goes down in value. And so you get that tax deduction over time. And in multifamily, it's 27 and a half years, I believe.
27 and a half, and then 39 years for commercial property.
Yep. And you have to deduct the land. I do know that, right? Land is not deductible.
Right, yeah. Remove it from the depreciation.
Right.
So, but if you buy like condos or things that you don't have ownership in any land, like those may be 100% depreciable in certain areas.
So imagine that, guys. Like you got cash flow coming from the properties, and you have depreciation from the whole complex offsetting the cash flow, and therefore we have a loss. So the loss is bigger than the cash flow, so you report a loss.
Right.
Like it's unbelievable, where you could actually have several $100,000 of cash flow, and you could have a $400,000 or $500,000 depreciation, and you would actually report a loss on the partnership.
Yeah, you'd report a loss. And this is good because you can do this at the end of the year too, or if you want to wait, you can do it after year end. So, like I, for example, I have rentals, and I noticed, I'm running out of deductions. Rents have increased. I need more deductions. So in December, I invested in some apartments, and 80% of what I invested because of the leverage and the bonus depreciation all became a deduction. So now all of a sudden, what I was going to pay tax on, I'm no longer paying tax on.
That's who's your tax guy?
He's really good. I gotta tell you.
No, guys, this is exactly how it's done. Like Eric was getting toward the end of the year. He took a look at his numbers. He's like, oh my gosh, I'm going to have a tax issue. And so he jumped in and got this depreciation to offset the tax that he already knew he was going to have. This is exactly how the wealthy stay wealthy and get even wealthier, right?
That's exactly right.
It's unbelievable. And this is all completely legal. So let's talk about the bonus, the fifth one, which is, of course, consult with a CPA. So, by the way, this is the $15.3 million mistake, right?
That's exact.
Tell the story.
So, and this happens more than what you think. So,
it's not my mistake.
Yeah.
I didn't make.
Ken would never make this
mistake. Well, because it'd be your problem. You're the one. I run everything through you. That's the difference.
Exactly. Even on holidays. But it sounds really basic, but people forget this all the time, how important it is to consult before you do a transaction. It doesn't help if you come afterwards, because a lot of times you can't change the structure of what's happening. So
real quick, I want you guys to understand how important that statement is. Ross and I will get an offer on something to sell something. We'll call Eric first before we even respond to the seller or the buyer. Well, I'll go, hey, Eric, what will this do for, against our taxes?
Yeah.
Every time. Like, this is so important that you guys just don't close stuff and then bring it all to a CPA and hope that they unwind it. This is such an important issue. You need to consult with them before so you understand what your tax liability, because we made a decision on one deal where he said we were going to close in December. He said close on January 2nd.
Yep. That's exactly right. Because I was like, we don't have enough deductions this year, but next year we could.
So guys, this is a property I had in escrow. I went to the buyer and said, hey, we want to close on January 2nd. They said, no problem. And so it pushed everything into the next year. This is a really important point if you're going to manage your taxes. So sorry to interrupt, but I am passionate about this one because I learned the hard way.
No, yeah, I am too. And this is something you don't want to learn the hard way. And you'll find out why in a second. But so I actually had a situation where I was talking to a potential client. So they weren't working with me quite yet. But they said, hey, once we wrap up prior year's returns, we want to get started with you. And so, I'm trying to figure out, okay, is there anything we need to talk about before that? Any type of planning you guys need to do to make sure that once we start working with you, that everything is going to be smooth? And they're like, oh, nope, we're good. Let's just touch base, and whatever. I think it was like September or something. And this was like, okay, that's just, if you have something like a transaction, let me know. And because it's better to talk about it. Don't be afraid of the hourly fees or things. Being afraid of that will often cost you more.
Well, in this case, it did.
Exactly. So anyway, we start working with them August, September of that year, and going through the tax returns, pulling everything together. And we notice that he sold a property and purchased one, and there was 1031 paperwork. So we're like, okay, looks like there was a 1031 exchange. Go through all the numbers and discover, wow, there's a huge problem here. He didn't buy enough property. So he thought
we had boot.
He had tons of boot because of all the cash he got out of the sale. But he had talked to one of his buddies, which is always the worst place to get tax advice from, and told him, oh yeah, just go ahead and buy this house and you won't owe any tax on it. So he talked to his buddy instead of a CPA. And so then we're looking at it, and it was not a fun call to tell him, hey, you now owe, because you didn't buy enough replacement property, there's a $15.3 million gain that you're not expecting. And so he's trying to figure out why, and we're walking through it. And just imagine you're in that place, right? So all of a sudden, and it was capital gain. So, that probably cost him another, it was like a $3 million tax liability.
Yeah. So here's how that works, guys. If I sell something at $10 million, I have to buy something that's at least $10 million to be net. I can buy 12, 15, 20. I just have to cover the 10. If I don't, then I have tax on that, and that tax is called boot.
Exactly.
So that's what happened here. Is the guy did a 1031. He obviously cashed out on something big and bought something less.
Yeah.
And he had a $15.3 million tax gain that he didn't know he had because he used a new CPA.
He hadn't switched to the best one yet.
Well, but it is true. Like these dates are and rules are non-negotiable. They're not flexible.
Yeah.
We're making it sound, I guess a little bit easy, but it's not. You miss a deadline, you don't hit the number that what the IRS says you could do, you're going to pay.
Yeah. I remember him asking too. He's like, so what can we do about this? I was like, well, last year when it was happening, but now the year's closed, everything's set in stone.
Yeah, back when you called him.
Yeah.
Yeah. And by the way, there is no we. You mean you. So, yeah, but the truth is, if he would have consulted you earlier, you would have caught it.
Yep, exactly, easily.
And that's kind of the lesson there. So it is important. I don't know, you guys, like a lot of you guys have bookkeepers. Nothing wrong with bookkeepers, but I will tell you, sometimes they're just processing returns. This is far different where somebody's actually managing your tax liability and trying to minimize it legally through, proper tax planning. If you guys like this, by the way, don't forget to click on the video that we also did, which is the 5 things that everyone can do to save money on their taxes. So, Eric, you're the best. Thanks, brother.
Thank you.